the presentation.
Okay. Okay, good morning.
Okay, thank you. Okay, sir, please start. I'm recording your video.
Okay, good morning. I'm Douglas Abrams, and this is Introduction to Venture Financing preview workshop. I'm going to talk about venture capital mindset. I'll talk about why companies raise venture capital and why people invest in venture capital, and then I'll talk about how venture capital investors evaluate startups for investment. So I want you to feel free to jump in with questions or comments. If we can make this interactive, it'll be great. So you guys can hear me, right?
Yes, I'm hearing you very clear.
Okay, good. So yeah, how many people are on the other end? How many people on your end?
12, 13.
And
13 people in meeting room now.
what's that?
13 people in the meeting room.
13. Okay. And then what about background of the people? Like everybody is a student?
More of them is the engineer and business guide.
Okay.
Just two students.
So anybody has anybody done a startup or involved in a startup now?
Sorry, can you repeat?
Can you repeat the question?
Oh, are any of the students involved in startups now?
My friend, can you help me to translate?
Any student involved in a startup? Can you hear us? The question is, any student involved in the startup right now?
Just two students in startup. And
No, actually not student. Anyone involved in the startup right now?
Yeah.
How many people are involved in the startup? Hello?
Hello?
Can you hear us? The question was, how many people involved in the startup?
Anh chị cho em với ạ? Dạ luôn.
How many people are involved in a startup?
13 people in the meeting room now, but 7 of them is involved in the startup company.
Oh, okay, great. Maybe we'll keep the questions from my end to a minimum so we don't get the lag in the response. Okay, so the first, you can hear me clearly now, right?
Yes.
I'll talk a little bit about my background. So I'm originally from the U.S. I went to UPenn undergrad. I went to Wharton for my MBA. I worked at J.P. Morgan on Wall Street for 14 years in investment banking technology and later global markets, internet products. Before I came to Singapore in 2000 to set up my first company called Parallax Capital Management, doing a hedge fund and early stage venture capital. I was co-managing the early stage venture capital practice at Parallax for 3 years. In 2003, I set up Expira, which is my current company, to do very early stage venture capital and venture services. And in 2001, I also started teaching at NUS, National University of Singapore. I'm an adjunct associate professor in a business school there, and also teach venture capital at SASIN, which is the business school at Chulalongkorn University in Bangkok, since 2007. This is it's a timeline view of my background in Expira. So I mentioned about Parallax, NUS. I'm also director and chairman of BANSI, which is Business Angel Network of Southeast Asia, since 2002. In 2007, I launched my first Expira fund called Expira IDM Ventures. In 2008, I launched my second venture fund called Extreme Ventures, which is a $20 million early stage fund. In 2011, we opened Expira's office in Thailand, in Bangkok. In 2012, I launched a third fund, Expira IDM Ventures 2, which is a seed stage fund. investing up to $255,000 per company. And in 2013, Expire Malaysia and KL. 2014, I4X, which is our Bangkok Accelerator program. And 2015, this year, Expire Ventures 3, which is a $30 million regional early stage fund, investing in Singapore, Thailand, Malaysia, Vietnam, and Japan. And in 2015 also, we're opening the Expira Vietnam yesterday and Expira Japan in next week. So that's a brief overview of my activities in the last 15 years as a venture capital investor, as a teacher, a lecturer, trainer, mentor, and entrepreneur myself, helping people start high-growth, high-tech companies from a variety of perspectives. So I'll try to share some of this perspective with you in the workshop today.
Okay, thank you, Douglas. Can I set the video to be on here? 1 minute, okay? Pause the recording.
Yes, I'm recording.
Okay.
Yes.
Go ahead.
Okay.
Yes.
So, yeah, any other questions about Expira before I continue?
Yes, I have a no question now.
Okay, so yeah, I want to talk about risk and return. Understanding the relationship between risk and return is the first step in understanding what I call the VC or venture capital mindset. And I think we're all probably familiar with this, but maybe we haven't thought deeply about it in terms of do you know what's the relationship between risk and return?
Yes, I see.
So, yeah, I think risk and return are highly positively correlated, which means that you can't increase your return without taking more risk. So I think that, usually we'll say high risk, high return, low risk, low return. And everybody knows that this is the case, but they don't really take the next step to understand more fully what that means for their own investment philosophy. So if low risk means low return, and you are currently not satisfied, you're not satisfied with your current return, then this means the only way to increase your current return is to take more risk. Unfortunately, I think a lot of investors spend way too much time thinking about how to increase their return without taking any more risk, which is both theoretically and practically impossible, because there is no way to increase return without taking more risk. Since usually when I do this talk, I ask people, how many of you are satisfied with your current return? And pretty much everybody says they're not. But then I ask, how many of you are willing to take more risk? And only a few people raise their hand. So the point I like to make here is you have two choices. Either you need to get satisfied with your current return, and then you can continue with your current risk level. Or if you want more return, you need to take more risk. So usually I challenge people to come up with any example of a low risk, high return investment opportunity. Can you think of any? Probably not. So yeah, I think you can try, but guaranteed you're not going to think of one. Or if you can think of one, you're going to realize that any low risk, high return opportunities that you can think of are extremely short-lived in financial markets, because financial markets tend to eliminate low risk, high return opportunities, because whoever is paying that return has no interest in paying a return that's incommensurate with the risk that in the investment. So typically these low risk, high return opportunities only present themselves for extremely short time intervals. I like to use example of high-frequency trading, where there are some high-frequency trading firms that identify low-risk, high-return opportunities in, for example, arbitraging financial instruments on two different exchanges where they can buy and sell the exact same thing at two different prices. But the time interval over which these opportunities persist are measured in picoseconds, which are unimaginably short intervals of time. So basically, the key point from this slide is, for all practical intents and purposes, there are no low-risk, high-return investment opportunities, only low-risk, low-return, high-risk, high-return, medium-risk, medium-return. So if you want to get more return, you need to take more risk. So how are you going to do that?
Yes.
If you're interested to generate more return
Yes.
by taking more risk. Yes, sorry, go ahead.
Yes, it's directly proportion. Return and risk are directly proportion.
Oh, risk and return directly proportional.
Correct. So, yeah, so how much risk are you currently taking?
How much risk are you currently taking? That's the question.
Yeah, like what type of risk are you taking now?
We have no question in this part. Please go on.
Oh, he said he's not taking any risk.
Yeah. So you're not taking any risk, therefore you're not generating any return, right? So, but good that you mentioned some of the students are involved in startups, so that means they are taking risk, because creating a startup is a very high risk activity. So this is where we're going to go next. Let's look at how does this fit to our understanding venture capital mindset. If we look at this table, this table shows us the returns to U.S. venture capital funds over the last 30 years as of second quarter last year, which is the most recent data that I have. Now, you might wonder why I'm using U.S. data when my presentation today is about venture capital in Southeast Asia. The reason is venture capital investment has existed in the U.S. for the last 50 years, so we have very good historical data. There's a lot of funds, and we're able to track the performance closely. So we get a good data set and good statistical results, whereas venture capital in Southeast Asia has only really begun in the last 10 years, and we don't have a lot of funds, we don't have a lot of good data. So to understand the risk-return profile in venture capital as an asset class, I like to use real data sets. I can say that my own experience as a venture capital investor in Southeast Asia for the last 15 years has pretty much mirrored the results from U.S. venture capital. So I don't feel that there's any fundamental reasons why we can't generate similar returns over 15, 20, 25, and 30-year time horizons here than the returns we're looking at in this table. So if I draw your attention to the U.S. Venture Capital Early Stage Index, which is what we've been doing, early stage venture capital, you can see the 15, 20, 25, and 30-year results are extremely favorable, so ranging from 30-year returns of 21% to 20-year returns of 52%. And compared to all other asset classes in this list, the returns are multiply higher. So like compared to S&P 500 index, for example, 10% 20-year returns versus 50%, so 5 times. That's because why? Because early stage venture capital is much riskier than public equities investment. In the second to bottom row, you see the returns from Expira's first fund, Expira IDM Ventures, from which has been investing for about 8 years. So I compare to the 5 to 10 year returns in the chart, and actually our results are comparable to, or maybe even better than, the index returns here. So that's why I said don't think that we're unable to use U.S. data. And then at the bottom row, you can see the long-term returns to residential real estate, which is the most popular asset class in Singapore and other parts of Southeast Asia. And actually looking at nominal returns around 4%, which means real returns are close to zero after inflation. So that's the numbers around high risk, high return. So now another point that might be interesting for you, if venture capital investors are generating returns like this, then the entrepreneurs that they are investing in are generating even higher returns for themselves, because for every return that we generate, the entrepreneurs are generating a huge multiple of that return, because entrepreneurs in startup companies buy their shares at par and we get our shares at a premium. So there's a little bit of data around risk and return in venture capital.
Yes.
The next slide illustrates an interesting point that you can, by adding venture capital to a normal diversified investment portfolio, you actually increase the return without increasing the risk, because the addition of a venture capital portion to a typical portfolio is surprisingly not making the portfolio more risky, because of the lack of positive correlation or maybe even negative correlation to the returns in venture capital investment versus public equities and commercial debt and cash and commodities that make up most investment portfolios. So this is why you see that most institutional investors have between 5 and 10% of their portfolio in venture capital funds. Now, moving away from just thinking about the numbers, you might wonder, next thing we want to think about for a venture capital mindset is, what type of companies do venture capital investors try to seek to invest in order to generate these type of returns? So this graphic shows a very small sample of companies that were founded with venture capital, meaning companies that got the early funding from venture capital funds. I think if you look at the names of the companies in this graphic, you're going to see that there's something similar about all the companies.
Yeah.
Like
Facebook, Cisco, FedEx, Google.
Mostly what?
Which companies is referred by expert in the graphic?
None of these companies are funded by Expara. These are companies that were funded by other venture capital funds. Can you identify any common characteristic of all these companies?
Sorry, I don't know what's the company in Singapore. Is the graphic?
Oh, yeah, these are not companies in Singapore. These are companies in the U.S., correct? So yeah, most of all these companies are U.S.-based companies.
Yeah.
But I believe that this is a function of the fact that this this table is showing the successful companies of today that were funded by venture capital, because this reflects venture capital investment over the last 20 or 30 years, which has been very aggressive in in the U.S. So actually we see the connection between venture capital investment and creating world-class companies. I think if you look at the list of companies, they tend to fall into some industry categories. Like, for example, you see a lot of tech companies, you see some medical and healthcare related companies, you see some clean energy related companies, but you also see some traditional companies like, or companies in traditional industries like Starbucks, which sells coffee, like Home Depot, which is a hardware store, like Staples, which is an office supply chain. So we can't just say all these companies are tech companies, but what we can say is each of these companies is or was a category leader in their product category in the world. So the most successful company in the world in their product category. For example, Google for search engines, FedEx for on-time package delivery, Starbucks for coffee. So here we see what venture capital investors are looking to do. They're looking to invest in companies that will become the leading company in their product category in their market. Now, for U.S. venture capital investors, this often means the company that will become the leading category in the world, the U.S. market or the world. For Southeast Asia or Asia-based venture capital investors, we look at, of course, we're also interested in investing in companies that will become the leading company in their product category in the world, but we also can look at investing in companies that will become the leading company in their product category in their local market or the region. So you can, we make investments in companies that, for example, could become the #1 company in Vietnam or in Southeast Asia or ASEAN or Asia, and we can still generate very attractive returns by doing that.
Yeah.
Okay, so moving to the next slide. How do venture capital investors actually make money? Venture capital investors make money by investing in small private companies at the early stages of development of these companies, and then helping the companies to grow to the point where these companies can be sold, either in a trade sale, which means that the company is sold whole to another company, typically a larger, much larger multinational company, or in an IPO, meaning that the company does a listing of its shares on a public exchange. So, trade sale, IPO, the two fundamental exit strategies for entrepreneurs that are seeking venture capital investment. Now, if you look at this table, you can see a list of companies, venture-funded companies that went to exits in Southeast Asia over the last 2 years, so 2014, 2013, and
More of them from Singapore.
Oh, say again?
Yes, more of them from Singapore.
What's it about from Singapore?
Yeah, a lot from Singapore. Because, why is that? Because Singapore has one of the most well-developed, or maybe the most well-developed, what I call enterprise ecosystem in Southeast Asia. And specifically, the venture capital market in Singapore has developed ahead of venture capital markets in most other countries in Southeast Asia. So that's why I think we're starting to see a lot of exits of Singapore-based companies, or a high percentage of exits coming from Singapore-based companies. Now, I expect that this distribution is going to change over time, because as more countries in the region develop venture capital industries, we'll see more venture-funded companies coming out of other countries and also more exits. So I'll just point to the first two companies on this list. has interesting examples of local exits that generated very, I'm sure, healthy returns for their investors and entrepreneurs. So the first company is called Zap.im. This is a company that does embedded chat help systems for websites. It was founded by some NUS students, two of whom were former students from my undergraduate class. They raised very little money for this company, I believe just one round of venture capital, maybe 600,000 Sing about. And in 2014, they sold their company to Zendesk for $30 million US. Now, this transaction also included a significant portion in Zendesk stock prior to Zendesk's IPO, and the stock appreciated in value after the IPO, so the total value of this transaction could be more than what we're seeing here. But I think it's a great example of a startup that became, based in Singapore, that became so attractive an acquisition candidate that Zendesk, who's one of the leaders in this industry from the US, bought them ahead of their IPO. And the founders also were just recent grads, maybe very similar to you, with some, some engineering or computer science background, and develop a innovative product with a strong value proposition, and a few years later sell the company for $30 million. The second company on the list, Nonstop Games. This is an example of another interesting local success story. The founder of this company was from Finland, and the brother of this founder is one of the developers of a very popular online game called Clash of Clans. And he came to Singapore back in 2010 to start his own game development studio. I met him when he first came to Singapore. He came to our office and took out some space in our incubator. Just one guy, CEO, and by 2014, last year, he had 25 people in office and sold his company to King, who is the publisher of the previously wildly popular game called Candy Crush. So, but now you can see like Candy Crush has declined in popularity, so King is using some of the money they made from that to go out and buy small, innovative, independent game studios so they can continue to launch successful games. And they bought this company for $100 million just last year.
Did you invest in this company?
We didn't. Yeah, unfortunately, we didn't have a chance to invest in this company because although we wanted to, but they were already past the fundraising funding stage that we were investing. At that time, we were investing only seed stage. They had already raised Series A. So, yeah, this was one that got away, and I really... but at least we wanted to invest, so we recognized the potential of this company right away. It's also, I think, very interesting phenomenon that these small independent game studios are now achieving very favorable valuations because with a small group of people, 5, 10, 20 people, you can create world-class games that are as good or better than games produced by massive game studios. But the key point I want to make on this list is there are real entrepreneurs in countries, and they're countries right around us that are creating real startups that are going to real exits on a regular basis. So this is not a U.S.-only phenomenon like the previous slides we looked at. This is real data from here. Now, I talked in the previous slide about trade sale and IPO being the two potential exit routes for venture-funded startups. And oftentimes we discuss with entrepreneurs what's their, we call exit strategy. So for exit strategy, we usually focus on trade sale. Actually, all the exits I showed you on the previous slide were trade sales. And if you look for IPOs of venture funding companies in Southeast Asia, they're extremely rare. But actually, IPOs of venture funding companies are extremely rare everywhere. So there are, I'm looking at U.S. data here where we have a very active IPO market, and still each year there are average 5 to 10 times as many trade sales as there are IPOs. So typically we'll focus on trade sale exit route because the returns are very healthy and the probability of an exit goes way up. You can see on the second chart, average deal size for trade sales is in the $100 to $200 million range, which is exactly how much we need to sell the company for to make our required returns. And if you see the 2012 number, the huge outsized IPO offer amount was driven driven significantly by the Facebook IPO that took place that year. So, and continuing to look at Southeast Asia data, this is, I think, a very exciting chart for entrepreneurs in the region and for venture investors in the region. This is data from my own personal study. So this is not comprehensive. Actual data should be more than this because I don't have data from all deals, but this is minimum data. So if you look at, say, pre-2013, what was the value of exits of venture-funded startups? Is it a question? Hello?
Hello?
Oh, you're back now, right?
Yeah, Mr. Mai already joined the class. Mr. Mai.
Because I tried to join the class.
Oh.
So something wrong.
Okay. So, yeah, so what we see here is you look at historical value of venture-funded exits in Southeast Asia, around 50, for example, 2010, $50 million. But in 2013, we see a big jump up to 400 million, and in 2014, last year, you see a big jump again up to 1.2 billion. Now, I think we may not see this. I'm sure we won't see this big of a jump everywhere, but every year. But we should continue to see steady growth in the value of exits. There are more and more venture-funded companies in Southeast Asia that have achieved significant valuations already that are going to be exiting in the next few years. So I think that we're going to see this growth continue, and this creates a very positive, virtuous cycle because as there are more exits of venture funding companies, this drives more investment in startups, which will drive more exits. So this is exactly what we need to grow the startup and venture capital ecosystem in Southeast Asia. And I think what we see in this chart is the fruits of the investment in startups that began around 2006, because we usually will expect something like a 5 to 10 year gestation period, if you will, between seed stage investment and venture funded company exits. And that is tracking this data very nicely. We looked at this already. So why would venture capital in Southeast Asia be starting to grow exponentially over the last few years? I believe that there's a couple of reasons. One is the removal or reduction or mitigation of barriers that have kept the industry from growing in the past. So one is the lack of exits that we had in the past, and now we can see that exits have increased dramatically over the last couple of years. And Also, the early stage valuations have been and remain favorable, allowing for profitable local exits, and then regional focus allowing larger exits. We have a historical lack of an enterprise ecosystem in the region. Enterprise ecosystem, or any type of ecosystem, is very difficult to develop because by definition in an ecosystem, all the components of the ecosystem are interdependent. So it's very hard for interdependent components to develop individually because they need one another to be mutually supportive. But we have broken out of that problem in Singapore by developing an ecosystem from the ground up. And this, I believe, also has very positive spillover effects in other countries in the region because the ability to connect into existing ecosystems means that new enterprise ecosystems don't have to spend as much time developing from scratch. We see a growing focus among entrepreneurs on innovation, and in the past, I believe there has always been a lot of entrepreneurial activity in Southeast Asia, but a lot of it was in traditional business entrepreneurship. And now, with the growth of a younger generation of entrepreneurs like yourselves, we see more and more entrepreneurs focusing on innovation-driven businesses rather than traditional businesses, and more changing environment for legal and corporate governance issues, and also cultural attitudes toward risk have been evolving over the last, at least last 15 years since I've been here, and we see more and more risk takers coming forward to start potentially high growth businesses and to invest in those businesses. Okay, so now I'm going to switch gears now. So far, I've been talking about the venture capital mindset around risk and return. So what drives venture investors to invest in startup companies? Now I want to look at the next level. How do venture capital investors select companies to invest in? We talked before about the fact that the type of company we're looking for is a company that will become the leader in their product category in their market. But and we also talked about how we don't anticipate that that's going to happen for maybe the next 5 to 10 years. So how to identify these companies at the early stage before they have a lot of evidence that there's a lot of evidence that these will be potentially category killer companies. So this is a challenge that we call the venture capital selection problem. How do we select the very highly promising companies to invest in? This is a methodology that we use to pick companies that have the chance, not just the chance to succeed, but the chance to succeed big, which we call scaling, once they launch our products into the market. We look at each investment and evaluate on these criteria, so I'll go through these one at a time now to understand in a little more detail how we evaluate investments. So the first thing we look at is, does this company solve a painful problem for customers? We call this value proposition. So first question I like to ask entrepreneurs, or a very early question, is, what is the customer pain that your product is addressing? And this is really important because, and there's a reason that this question heads our list, because if you don't solve a painful problem for customers, then it's going to be very difficult for you to generate sufficient demand for your product, which is actually the most common reason that startups fail. Most startups that fail will fail because sufficient demand does not materialize for their product. Now, we have some approaches to try to mitigate this, like you probably have heard about lean startup, where we work closely with customers in the early stages of product development to try to make sure we're solving a painful problem. But first, we have to begin with a theory that we have a product or service, or product and service that will solve a painful problem for customers. If your product does not solve a painful problem for customers, then we call it a me-too product or a nice-to-have product, which is very difficult to build a successful new company around because customers have many options on which to spend their money, and they're probably pretty satisfied with a lot of the current products that they're using. So unless your product solves a painful problem, it's very hard to get sufficient initial demand and also scale. Second thing we look at is, and again, number 1 and 2, so value proposition and innovation, we usually think about together, but I have to pick some order here. So we also strongly prefer companies, startup companies with innovative products or services or some form of innovation. So innovation can take many forms, not just technology innovation, but also business model innovation, user experience innovation, process innovation, and supply chain innovation, etc. But we like to see something innovative about the new company product. Why? If your product is not innovative, then you're just a me-too product, meaning you're copying something somebody else is doing, which can be not a bad strategy for achieving some level of success, but it's very difficult to scale. So if you think about every product category, every new product category should have one innovator and then multiple copiers, me-toos. So some of the me-toos are going to do okay, but the innovators, if they succeed, typically will succeed much bigger than the copiers. And among innovators, the innovators that succeed to the highest degree are the successful disruptive innovators. So if you look at the market, let's say look at startup company investment market today, I think 2 of the companies you're going to come across that are getting a lot of attention are Airbnb and Uber, and both of these companies have always achieved multi-billion-dollar valuations through many rounds of venture capital investment. So you might wonder, what makes these companies so special? Why is it that investors are valuing these companies so highly? And I think the reason comes down to they are both disruptive innovators. So Airbnb is disrupting accommodation industry, and Uber is disrupting the taxi industry. So when startups are successful disruptive innovators, they have the potential to become multi-billion-dollar companies over relatively short periods of time. What's so special about innovation, and why do we value it so highly? You can understand why customer pain is important, because it stimulates demand. But what's so special about innovation? Innovation is valuable for a couple of reasons, but which I'll list. So one is innovative companies tend to enter markets during high growth periods because new markets grow on an S-curve, and innovative products come in at the early part of the S, or at the inflection point in the S-curve. And also, innovative products tend to be harder to copy because either the product innovation or the business model innovation or whatever the innovation that's driving this product are difficult for existing players to replicate. Now, example, business model innovation of something like Airbnb, it's extremely difficult for the existing accommodation industry to replicate. So this is how startup companies beat established players. One of the fundamental strategies is using innovative products and services or business models that are very difficult for the established guys to copy. Next thing we look at is the customers and competitors. So who is the customer? what market is this company targeting, how big is it, and how fast is it growing. We really, we prefer very fast growth markets, which I think you can understand because we're trying to create fast growth companies. It's a lot easier for new companies to grow fast in markets that are themselves growing fast, because if a market is growing fast, it means it's adding a lot of new customers by definition. And as a new company, we would prefer to capture customers who are new to a market rather than try to take customers away from existing players in a slow growth market, which is an extremely expensive and difficult to execute strategy for a startup. The next thing we want to see is the company has reasonable marketing, sales, and distribution strategies. So we want to understand, how does the company plan to capture the market opportunity that they have identified? Can they profitably market, sell, and distribute their product in a way that enables them to become ultimately cash flow positive or profitable? Because if you think about where we're going with this, we're trying to, now that we have decided to invest in highly risky, high growth companies, we're trying to pick the ones that are most likely to succeed. So we try to systematically reduce or eliminate one risk after another. So value proposition attempts to mitigate the risk that insufficient demand will develop for this product. Innovation attempts to mitigate the risk that somebody very quickly is going to copy our product or service and beat us in the market. Picking fast growth markets, again, attempts to mitigate the possibility that we can launch an innovative product that solves a painful customer problem, but the market is not big enough to support our scaling. Our marketing, sales, and distribution strategy attempts to mitigate the possibility that we can actually identify the right market with the right product, but we can't make a profitable company based on that. And then we look at sustainable competitive advantage, which means the company's ability to succeed when competition enters. Because for every new company with an innovative product, there's going to be many competitors, like we talked about. These competitors can take several forms. I usually like to think about the competitors coming from two main categories. One is other startups, so copycats. Two is large companies that look to startups to identify interesting opportunities for them and wait for the market to develop to a certain point and then jump in with effectively unlimited resources to out the startup and capture value for themselves. In the end, companies, to be successful, they need to beat the competition. In order to beat the competition, they need to have the ability to create barriers to entry for followers, sustainable barriers to entry. So those generally take two forms: intellectual property barriers and competitive strategies that create barriers. So we look at what is the company's ability and strategy for doing that. Oh. Is there a question?
Yes, I have a question.
Yeah, go ahead.
So
I lost
in terms of barriers to entry.
Oh, I lost the video now.
Oh.
And the microphone is muted also.
I'm here still. I'm thinking. So in terms of competitive barrier to entry, a company can have a local environment condition that allow it to compete, to bar competition locally, like either government regulation or so on. But then when it goes to different market, this barrier to entry no longer exists. What are your comments on that?
So then this will influence or needs to be related to the strategy. So if the company, let's say the strategy for this company is to become the dominant player in a local market, and we're going to get to exit on the basis of that, then the local barriers to entry will be sufficient. If the company's strategy is dependent on a regional or larger exit, but we only have the reasonable barriers to entry in the local market, then we have a big problem. So this comes up a lot more than you might think. For example, we have a business plan or an idea for a company that is looking to do, let's say food delivery. This is a very hot category. There's dozens or hundreds of companies I think in Southeast Asia alone that are launching food delivery startups, and this is in the U.S. too. But let's say we see a lot of business plan for a company that has a pretty maybe interesting or effective strategy for creating barriers to entry in the local market for their food delivery business. This is something called a network effect or network externalities. So, for example, I see a lot of business plans that are Uber for X, meaning a peer-to-peer business model in a previously untapped segment. So trying to implement a peer-to-peer business model in a segment that was previously traditional market structure with hub and spoke. So restaurants, a small number of restaurants delivering food to a large number of people buying food. Now we can see a lot of business models of local startups trying to connect people who are preparing food, maybe in their home, with people that want food delivery. So you can envision that this could be a pretty successful strategy within a district or a neighborhood or even a city, because if we sign up enough people who are preparing food and we sign up enough people who want food delivery within a given geographical area, it's very difficult for the next guy to dislodge us. Why? Because when you go to order food, you will join the local food delivery network that already has the most people providing food, because you want somebody close to your house so you don't have to go out of your way for delivery. On the other hand, if you're somebody preparing food for delivery, you would like to go to a network that already has a large number of people buying food so that you're more likely to be able to sell your food. So that's great in companies that start out in a particular area and build this network effect or network externality, but how to translate that into the next market? And usually the answer is no, so there's no real advantage once you have an initial network in a particular geography to doing this in the next geography. And actually it can work against you, because in competitors in other geographies see what you're doing and they build up their own network before you have a chance to enter in the next network. And actually you can see, for example, even a company as big and successful as Uber has encountered this already, because their network effect hasn't necessarily blocked Southeast Asia competitors like Grab Taxi from taking significant share away from them in new markets. So I think this is a real challenge, and if your initial competitive advantage is local, but your strategy is regional or larger, you're going to have a competitive advantage strategy for the next market too. I'm seeing a message that suggests that the video has been lost. Is it correct?
I see. Okay. So that's fine. That's okay. Thank you for your answer. It's very good. And you are correctly stating the impact of local competition, because in different cities, like in Hanoi, Grab Taxi is much more popular than Uber, whereas in Ho Chi Minh City, Uber is more popular than Grab Taxi. And likewise in Singapore, and so on and so forth. So I think that there's still a chance for putting up barrier to entry for local company if they execute well. Thank you.
Oh, you're welcome. Okay, so can I see the student video again? Are the students?
Yes, I got it. Thanks, sir.
Oh, there we are. Okay. Welcome back, students. Okay. So that was a good question. Thanks, Frank. And then now, of course, and students have any questions? Any questions about the key elements for success?
Please, white hand on. Oh, yeah. Anyone has any question? Mr. Sir, please go on, sir. We already got it.
Okay, great. So next thing that we look at after competitive advantage, we look at the business model and financial plan. I'll go into that in more detail in a subsequent slide, but basically we want to understand what is the company's business model and financial plan that they will execute around this product strategy. So if you think about looking at the first 5 points and then the 6th point, actually, as an entrepreneur, there are two things you're presenting to investors. One is the product strategy. 2 is the financing strategy or financial offer. So both of these have to make sense in order for the business to raise money and, of course, ultimately for the business to succeed. So you have to think about how are we going to actually create a successful product, and then how are we going to finance this company so that it grows to scale in a reasonable amount of time. And then my last point, although last in the list but not in any sense last in importance, is the team. So we will tend to evaluate teams by dividing into 2 types of teams. We call the A team or B team. An A team is a strong team and a B team is a weak team. So we will say the A team, meaning a strong team, can succeed with almost any idea. A B team will screw up the best idea in the world. So team is different from all the other items on this list because the other items on this list we may be willing to make some allowances for. So if let's say financial strategy, it's not perfect or not clear, or the innovation is good but it could be better, marketing, sales, and distribution can use some work. This happens a lot, and we're willing to overlook that and to work with the company to help them improve those. But if we don't feel confidence in the team, then we never invest. So we say another way to say this is when we pick the 3 most important characteristics for success from this list, number 1 is team, number 2 is team, and number 3 is team. So team, team, and team, just like location, location, location in real estate. And these 2 are parallel for the same reason in a sense. Why is location so important in real estate? It's because you can change everything about a piece of property except the location. And why is team so important in a startup is teams either execute successfully or they don't. Teams that execute successfully will win. Teams that don't execute successfully will lose. So in the end, we prioritize team over everything, and especially at early stage, because team is almost the only tangible thing you have to show. When I say early stage, I mean maybe you don't have a product yet, don't have customers yet, don't have revenue, or even if you do have, you probably have very small amounts of those, but the team is tangible. So a strong team means a team with relevant experience and expertise, a team with complementary skill sets, a team that we can trust, a team that has a track record of working well together, or if they don't, that appears that they'll be willing to work well together and that has good chemistry and also trustworthy team members. So first step in this process is have a strong team. Some of the weaknesses we see in startup teams that are easily avoided, lack of full-time commitment. So we meet startups where there appears to be a very strong team, but actually most people on the team are not full-time doing something else. and we don't like to see that. We want to see full-time committed teams. So it's better to have a small team that's full-time and committed than a larger team where people are doing something else. Okay, so that's our key elements for success. Now we know how investors tend to think about investing in businesses, and the reason that we pick these elements is because we think that they're the ones that determine whether the company has a real chance to scale. Therefore, entrepreneurs should also be thinking really hard about these and should be developing their business plan around these elements. Now, finance plan. So I mentioned there are two main categories in which investors are evaluating your business ideas. One is the product and one is the finance. So the product side and the financial side. These are the key elements in the financial side of the plan. So business model means how is the company going to make money? What are the key revenue drivers and what are the key cost drivers? Business model also offers significant scope for innovation. And if you look at some of the most successful startups, they will combine a product innovation with a business model innovation. So the two companies I mentioned before, Uber and Airbnb, they're almost 100% driven by business model innovation. And this is why, as an entrepreneur, you want to think not just about product innovation, but business model innovation. If you can think of the next big business model innovation, you can also use that to drive successful startups. And in case you feel like all the business model innovations are already done, but both Airbnb and Uber started within the last 5 years. And in fact, the business model innovation that they are examples of, which is peer-to-peer or sharing economy, was not brand new. So eBay introduced peer-to-peer retail 20 years ago or 20 plus years ago. So adapting an existing innovative business model to a new market or product category can also be a very effective form of innovation. And in fact, we have some special advantages in this sense because being in Southeast Asia, we can look at business models that are successful even in other geographies, and if we can regionally or locally adapt these in big enough markets with a strong enough execution strategy, we can create a successful company on the basis of that, just like the Grab Taxi example I gave before. So we're always on the lookout for those type of opportunities. Next thing we like to see is financial projections. So this is a financial model that you build of your company that takes the business model and adds some real data to the business model, then projects that data into the future to see, can this company's business model actually scale? Meaning, can the company's business model generate the required financial return that we look at in the company? And without doing financial projections, we won't know that. Without doing financial projections, we'll just be assuming that. So although there's a lot of variability in financial projections for startups, I believe that it's still extremely valuable exercise to do these financial projections just in the even in the case where it just shows you that your business model can work. The next thing we need to see in the financial plan is the company valuation. So this means what is the value of the business today? Because the most common form of investment that we make is equity investment, which means we buy shares in a company. And in order to figure out how many shares we will acquire in the company for a given investment, we need to know what's the valuation for the company as a whole. This will be one of the most difficult to negotiate terms in the investment agreement because typically investors want lower valuations and startup entrepreneurs want higher valuations. Why? Because if you because Entrepreneurs, when they set up a company, they'll have 100% of the equity. When they go to raise investment, the investor share will come out of their share. Therefore, they will be diluted. And that means that their percentage of the company they own will go down. However, the valuation should go up, and therefore the total value of their shareholding should also go up, which we'll look at in the upcoming example. But fundamentally, entrepreneurs want to limit dilution, and investors want to get a good price. So we'll have to negotiate on valuation. But as an entrepreneur, it's good to understand what is the market valuation for our company, because one of the things we look at as investors is, does the startup company or the entrepreneur know what's a reasonable valuation for the company given their stage of development? And if the answer to that question is no, that's a bad start to our discussion. Why? Because what are the reasons that the entrepreneur doesn't really know what's a reasonable valuation for their company? Either they're not familiar with the market, which is not a good sign, or they have unrealistic expectation, which is also not a good sign. So how much, next point, we call funding required and equity offered. So that means how much money does the company need and how much equity will be exchanged for this investment. And typically companies should raise only enough money to get them to either their next funding milestone or to cash flow positive, because the valuation of the company will go up over time. In the lifetime of a venture-funded company, they will raise several or maybe many rounds of funding, depending on how big they're going to grow. And each time the valuation should go up, which means equity will become more valuable. Therefore, at every fundraising stage, you should sell only as much equity as you need to get you to the next fundraising, or to get you to the point where you don't need future funding, although you might want to take it to accelerate growth. So the mental model I like to use to understand this is, imagine you have 100 ounces of gold, which equals your 100% equity in a company. Now, oh, is it a question? Does somebody have a question?
Yeah, let's go on. Just some technical problem. Yeah.
Oh, technical problem? Okay.
Yeah. It's okay with you now.
So the example I was starting to give, if you had 100 ounces of gold, but you have a very strong view that over the next 5 years, gold is going to appreciate in value, you wouldn't sell all your gold today. You would sell over the next 5 years only enough to take care of expenses, and this is what we want to do with our equity. We want to sell it over time as it goes up in value. Now, how much equity should you expect to give up in each funding round is a common question from entrepreneurs. I would, my feeling is you should expect to give up somewhere between 15 and 35% equity at each funding round. In most cases, most deals will be done at about that level. Some cases a little less, some cases a little more. But investors who expect too much equity are also, I think, a big problem, just like entrepreneurs whose valuations are too high. So as an entrepreneur, if you're approached by or working with or negotiating with an investor that's asking for too much equity, that should be a red flag for you, meaning that's something I would be very careful about. For example, if an investor is looking for 50% or more of the company, then you probably don't want to deal with that investor. Next thing that you'll see in a good financial plan is use of proceeds, which means how are we going to use the money? How will the company use the money that the investor is going to put in? This is very simple. The investor expects that the company will use the money invested in order to stimulate or increase growth, because the whole concept behind this type of funding, we put money into the company the company uses it to grow, increase the valuation, then we raise more money in order to grow further, increase the valuation, and repeat until we get to exit. Exit strategy and ROI. So we talked about exit strategy already. This means how is the company going to create a liquidity event for investors, meaning how will the company give investors a chance to make money by selling their shares? Two main ways to do this are trade sale and IPO. And then ROI means what type of return do investors expect? This varies by stage. So at seed stage, investors should expect around what we call 30x return, which means for every dollar they put in, they should get $30 back. As the company goes through additional funding rounds, that should go down. So Series A can be 10 to 20x, Series B 5 to 10x, Series C 3 to 5x, etc. So this has important implications for valuation because the return that investors get is basically equal to the valuation when we sell the company divided by the valuation at which we invested, adjusted for our own dilution. So that's something that comes into play heavily when we calculate valuation, and therefore something entrepreneurs should be aware of. And another key component of your financial plan is the cap table. Cap table shows the existing distribution of shares in the company along with what the shareholding will look like after the investment goes in. So this should show how many shares each founder has, and also any shares that are held by investors that came in before the current investor. This also will usually illustrate the shares that will either have been or will be allocated to an ESOS, which is Employee Stock Ownership Scheme. So if you haven't constructed the cap table yet, then this is something you want to do as part of your financial plan. I mentioned how important valuation is to both entrepreneur and investor. So there are 6 methods that we can use to calculate valuation in general. The first 3 on this list generally don't work for seed stage companies because they require existing financial results. So typically we'll use the last 3 for valuing seed or early stage company, which is comparables valuation, discounted cash flow valuation, and VC method. These are a little complicated and require long explanations if you're not familiar with them already. So I'll just give a quick summary of each one. But if you're interested, these are good areas to research to understand better how startups get valued, at least valued prior to negotiation. So in comparables valuation, we value companies, as you might guess, based on the value of comparable companies. So for startups, it's very hard to get comparable valuations because the data is not published in most cases. So I tend to use comparables by stage, meaning look at across a universe of seed or a large enough sample of seed stage companies. We can get a good idea of what the valuation ranges are. For example, in Singapore, most seed stage companies are valued between $1 and $3 million pre-money. So that gives us a good benchmark for the other 2 methods. Discounted cash flow valuation, we take our financial forecasts, which show our projected cash flows, and we discount those back to today at some discount rate. The key here is what discount rate do we use? So for seed stage companies, we'll use a very high discount rate, somewhere between 60 and 100%, which is derived from our understanding of investors' required return on investment at the seed stage. And in VC method, we will value the company based on how much money does the company need today, what is the projected exit valuation of this company, what is the VC's required return based on stage of investment, how much dilution can the VC expect to incur before the company gets to exit, and then that enables us to calculate the current valuation. Now, interesting to note, or important to note, is all of these methods are only precursors to negotiation. Real valuations are arrived at through negotiation between entrepreneur and investor. So don't confuse your calculated valuations with the real valuation. Real valuation comes through negotiation. The best way for startups to get higher valuations is to get multiple interested investors. If there are more than one investor interested in your company, you'll get a favorable valuation. If only one investor is interested, then you'll probably get a valuation that's closer to the investor's valuation. Now, this next table, this next chart illustrates the key innovation in venture capital funding itself. So venture capital funding itself is a financing innovation, which is why it has been so successful in generating companies that are category leaders in their product category in the world. Now, if you think about what's the painful problem that was solved by venture capital financing innovation, it is that, or let's say, what is the venture capital financing innovation? It's financing in stages. As companies meet funding milestones, more money is invested at higher valuations, enabling companies to grow very fast around innovative products and business models and raise amounts of money that are necessary to do this that would have been impossible with any other funding method. How does it work? Imagine, let's say if you have an idea for a disruptive startup. Now, depending on your product category, we don't know exactly how much money you're going to need to raise, but it's likely to be a lot. If you think about the companies I talked about before, like Uber and Airbnb, they've raised tens of millions, or in some cases hundreds of millions of dollars in venture capital. Now, if this funding was not put into companies in stages, it would be impossible to fund businesses like this. Why? Let's say you needed even only $20 million to take your company from startup to exit. But you're very unlikely to find an investor that would invest $20 million in your company up front because it's too much to invest in a new company. Even if you could find an investor that was willing to invest that much, you probably wouldn't want the investment because the valuation of the new company will be too low to make this investment interesting to the entrepreneur. So by dividing up the funding of the company into multiple stages like we do here, we create a win-win for entrepreneur and investor, because investors are able to invest small amounts of money at the beginning and increasingly larger amounts of money as the business succeeds, and entrepreneurs are able to raise money at valuations that make sense for them, so they don't have to give up too much of the company at each stage, and they're able to prove the idea by generating results with each funding. So you can see that the funding process here starts with OM, which is own money. This is a term that we use to distinguish between own money and OPM, which is other people's money. We like to see that entrepreneurs begin with some of their own money, because this creates for the entrepreneur something that we call as investors skin in the game. Skin in the game means that if the company fails, the entrepreneur suffers. Now, we don't want the entrepreneur to suffer too much. I don't think they should have their lung in the game or heart in the game so that if their company fails, they die. But we like to see entrepreneurs with some skin in the game so that they are subject to some financial loss if the company fails. This helps the entrepreneur to make better decisions on how to spend money, because most of us are much more willing to spend other people's money than we are to spend our own money. We would like the entrepreneur to feel like in the startup they're spending our money, meaning jointly rather than my money, just the investor's money. We also like to see entrepreneurs with some FF and F funding. This is friends, family, and fools, which is sort of a joke, but the key is the friends and family part. We like to see that entrepreneurs have raised some money from friends and family before they go to outside investors for a couple of reasons. One, we believe that if the idea is as attractive as entrepreneurs are presenting it to be, they would be eager to share this idea with friends and family investors who are going to make a lot of money. And then it also shows that the people that know the entrepreneur the best are willing to invest some money in their company, which is good for trust, and the converse not so good if the people that really know you the best are not willing to invest in your company. That raises some questions about why. Then the reason we have the third F, fools, because investors who are not either friends or family, that invest at this stage are taking tremendous risk. But in fact, we sometimes invest at this stage too, so I don't think it's really foolish. After the founder's capital, then typically startups go to incubators, accelerators, seed or angel investors who put in the first funding, which are relatively small amounts at reasonable valuations. I distinguish seed from angel investors because I'll define a seed investor as a company or institution that invests in very early stage startups, and an angel investor as an individual who does the same thing. After seed or angel investment, then startups will typically go to traditional venture capital investors for their what we call Series A, Series B, Series C funding. These are funding rounds that increase in size and valuation as the company meets successive funding milestones. They tend to track the company growth phases, which are seed, early stage, and then growth. But the exact tracking will depend on the industry and the company. And after venture capital rounds, companies might raise some other types of funding in financial markets, and then they go to exit, either IPO or trade sale. You notice that the investor's required return on investment goes down in subsequent funding rounds because the risk in the investment has been reduced because the company has already met previous round funding milestones. So that's why the valuations are able to go up, investor hurdle rates go down, and entrepreneurs are able to raise a lot of money for successful startups at reasonable valuations until they make it to exit. Now, you probably have heard about crowdfunding, which I think crowdfunding is a very exciting addition to the venture capital markets and has the potential to democratize venture capital, bring a lot of new investors into the market, and create more options for startups. Now, there are several types of crowdfunding. The most well-known type is the donation funding or gifting that is epitomized by Kickstarter. Now, I believe that this type of crowdfunding has limited value for startups because, for example, here, Kickstarter, which is the most successful gifting crowdfunding site in the world, you can see based on data that I took off their site because they present very detailed data about the projects. So looking at from the point in time where I pulled this data, which is a few months ago, there were 243,000 projects launched on Kickstarter, of which roughly only 1/3 were successfully funded, and of the 1/3 that were successfully funded, almost 3/4 raised less than $10,000. So this is usually not enough money to fund a startup. There were only 110 projects that raised $1 million or more. So I think that this is not something to ignore. I mean, something like gifting crowdfunding can be an interesting addition to the company's fundraising strategy and also marketing mix, but it's at this point, and I think long term, it's not going to play a significant role in venture funding because the reason these amounts are so small is because the people that put in the money just don't get financial return in exchange, which is going to limit, I think, for the long term, how much money comes into companies this way. On the other hand, equity crowdfunding has, I think, real potential to become a key player in venture capital markets, although today it's still very small. So again, looking at U.S., where this market is most well developed, we see in the same time period during which there was $13.4 billion worth of venture capital going into startups, there was only $662 million of equity crowdfunding, but this is a new sector, and we're going to expect to see this grow significantly over time. So I think we need to watch carefully the relative amounts of equity crowdfunding that are available, and this can become a very interesting aspect of companies' fundraising strategies. In Southeast Asia specifically, equity crowdfunding has been approved by governments in Thailand and Malaysia, and Singapore is currently getting ready to launch some equity crowdfunding sites. So I think definitely we need to consider this as a startup. I don't believe that equity crowdfunding itself will replace venture capital investment because, especially at the early stage, venture capital investors provide much more than just funding for their companies. They provide support that is, for many startup companies, as or more important than the funding. It's hard to see that the equity crowdfunding sites are going to be able to match this, at least with the current business models. So I think we're going to see equity crowdfunding contributing to the growth of venture capital industry in Southeast Asia, but not displacing traditional venture capital, at least not just yet. I talked before about dilution and ROI. So this is a little more detail on that. If you look at the second example, you can see how a typical fundraising goes for a typical startup company. So the founders begin with 100% of the equity. The founders in this case invested $100,000 and they received 100% of equity in exchange for that. They brought in a seed investor for $500,000 at a $2 million pre-money valuation. That seed investor then received 20% of the company, which came out of the founder's share, so founders left with 80%. However, the value of their stake has increased significantly in this round because they now have 20% of a company that's worth $2.5 million, whereas before they had 100% of a company that was worth only $100,000. So definitely I would prefer to have 80% of a company worth $2.5 million, which is value to me of $2 million, than 100% of a company that's worth $100,000. And this process continues throughout the Series A, B fundraising. Investors come in at successively higher valuations. They invest larger and larger amounts of money, but the value, therefore, of the entrepreneur's stake goes up. And by the exit, the entrepreneurs have realized a return on their investment of 480 times because they invested $100,000 and they take out $48 million at the exit. And this also illustrates what I was talking about before. The return multiple for each of the investors is significantly less than the founder's return because founders come in at the lowest possible valuation. And then on this slide, we see the key terms of venture capital investment deals. So these terms fall into two main categories, which I call economics and control. So economic terms include valuation, amount of financing, which we talked about already, liquidation preference, which means that investors receive more than their pro rata share of a return at an exit, meaning typically liquidation preference will be 1 or 2x the original investment. So if an investor put in $1 million, they would receive back first $1 million and after that their share of the proceeds. This helps protect investors against companies that exit at too low valuations. Vesting means founders will need to earn their equity shares over time. So this is very important. This is as important for entrepreneurs as it is for investors. Because imagine a company with 4 founders, each has 25%. An investor comes in and gets 20%, leaving each of the founders with 20%. But if one of those founders leaves very soon after the investment or any time, let's say over the next couple of years, vesting agreement prevents the departing founder from taking all their shares with them. We need the shares in the company to reward the founders that stay with the company and also for future key hires and management team. So vesting helps us to accomplish this. Option pool also looks at the future because it enables the company to set aside some percentage of their shares to be issued as options. Anti-dilution protects investors against companies raising future rounds of funding at a lower valuation or lower price than the price that we paid. And pay-to-play offsets the anti-dilution clause because it also requires investors who have anti-dilution to participate in down round funding in order to maintain their rights. On the control side, investors will almost always want a seat on the board of directors. They will insist on protective provisions, which means that the affirmative vote of their director and possibly their shareholder will be required in order for the company to take any actions that might reduce the value of the investor's shares. And drag-along agreements prevent a case where entrepreneurs never want to sell the company, because drag-along agreements mean after some period of time, investors who find buyers for the company can drag along other shareholders. And conversion means that preferred shares held by investors have an option to convert to ordinary shares. So you can see that the terms in the investment agreements are pretty detailed and complex, and as entrepreneurs, it's very important that you understand each of these terms before you sign agreements, because they can have important consequences both for you economically and as a member of the management team. So I would advise everybody before going to getting venture capital investment that you make sure you understand each of these terms and any other terms in the investment agreement. So this is contact information for me in case you have questions or want to follow up on anything that we talked about in the presentation today. If you decide to fund your own startup company or looking for investment or advice for your startup company, or interested in getting involved in startup accelerator incubation programs, in fact, we and Microsoft are getting to launch acceleration program right here in Vietnam and looking for companies that are interested to participate. So if you, in your startups, or if you know other startup entrepreneurs that are interested to apply for acceleration programs, then definitely feel free to contact me. So this brings me to the end of the lecture portion of my presentation today. So if you have any questions, I'm happy to answer now.
Douglas, this is Francis. Can you hear me?
Yes, I can hear you.
Okay, so I just want to make a comment on the crowdsource funding. I think that crowdsource funding is very problematic, because unless it's done correctly, it's also an opportunity for money laundering, right? And that's the first thing. The second thing is I think that the main reason why people fund a startup is because of the team. It's very difficult to use an online medium to be able to validate the caliber of a team, right? And the most important thing for an investor when they're investing in a company is the team, and the team. So I think that crowdsource funding will work for a small-scale investment up to a certain amount. And beyond that, I don't think that crowdsource funding can scale or can be successful because of the two problems that I mentioned. One is the condition to prevent money laundering, and the two thing is the the condition to allow the investor to be able to validate the caliber of the team. Well, can you comment on that?
Yeah, I agree. I mean, actually, I see a couple of I think that those are both the real challenges in equity crowdfunding. I see some other potential risks in equity crowdfunding too. In addition to the money laundering issue that you raised, I see, and I started out my presentation today by talking about the risk return profile in venture capital investing, high risk, high return. Today, most of the investors that are involved in funding startups understand this risk, and in most cases, they're what we call sophisticated investors who are actively seeking higher returns, but who recognize that that means there's a very good chance that they can lose a lot of money in this type of investment. And as equity crowdfunding becomes available to more and more people, assuming that, I mean, if it's really pure crowdfunding, it won't be limited to sophisticated investors. So we might see less sophisticated investors getting involved in funding startups. And although, you know, they might have to click on a disclaimer that says they understand the risk, that doesn't mean that they really understand the risk. And I believe that we, in equity crowdfunding, will see examples, we will see situations where companies defraud crowdfunding investors because of lack of proper deal flow screening, and also the situations where startups or companies don't defraud investors but just reasonably fail, but the investors might not have understood that risk. So, for example, if you look at in Thailand, so in Thailand, the investment is limited to $1,500 US per investor. So $1,500 is equivalent to about 45,000 Thai baht, which seems like not that much money, but actually for a small investor in Thailand, that could be a lot of money. So let's say 45 or 50,000 Thai baht. If I'm just a normal working class person in Bangkok, that could be a couple months of salary. So if I lose that investing in a startup, that's going to hurt. And I believe that this is inevitable in equity crowdfunding, that people will experience losses, and that could be another big challenge in the growth of equity crowdfunding. So I agree there's some significant limitations, at least currently, in how big equity crowdfunding can grow. But we need to carefully monitor this and see how it fits into the ecosystem.
Any question from the on-site team in Da Nang?
Everyone with any question? Okay, so the presentation is almost clear, and maybe the member in Da Nang have question.
Okay, so thank you, Da Nang team, for hosting this workshop today. Thank you, Douglas, for presenting it. And we will, so this is being recorded, so we actually will post it on the UBET site so that other people can download and view. And I just want to follow on with Douglas' last comment about Microsoft and Expara opening an accelerator. So you should see announcement coming the beginning of November, and we hope that this partnership will work out and opening up a new horizon for Vietnamese startup company. Thank you, Douglas, for presenting today, and thank you for Da Nang for hosting the UBET team in Da Nang for hosting this presentation. Thank you. Bye bye.
Okay, thank you, Douglas, Mr. Douglas. Thank you, Anne Frank.
Thank you.